I like to keep these intros as short as possible, so let's rock and roll. I'm Andrew with Investors Hub, and today we're going to be talking with Brett Arends. He's a retirement columnist for MarketWatch, and he's going to be chatting with us about Tesla. If you like the content, be sure to like, comment, and subscribe. Chapter points are coming up next, and let's hear from Brett. So what does joining the S&P 500 mean for the long-term valuation of Tesla?
Well, Tesla joining the S&P 500 means it's now included in every single S&P 500 index fund, large cap index fund, which is actually where most ordinary Main Street investors have their money. That is sort of the core of the investment portfolio in the typical 401k or IRA. So everyone basically has just become an investor in Tesla after it's risen all the way from $3 or so when it was did its IPO to whatever the hell it is now, some crazy price. So this has helped drive the price of Tesla up because the index funds have to buy the stock, whether they like it or not, regardless of the valuation. And so it's pushed Tesla up. I mean, it is very difficult or impossible to justify the valuations placed on Tesla at these levels. You have to engage in heroic calculations to come up with some kind of future where this makes sense. And by the way, I'm not a long-term Tesla skeptic. A few years ago, I was in Scotland and I interviewed one of the biggest outside investors in Tesla, Baillie Gifford, a growth-oriented fund manager in Edinburgh. And they were the second or third largest holder in Tesla. And they were very bullish on the stock. And I wrote a whole article about their argument about why it could double. I think at that point, since then, it's gone up like fivefold or something. It's this last year, it just went insane. And going into the index, because it forced so many index funds to buy it, helped drive the price up further. But at these levels, it's hard, if not impossible, to justify these valuations.
So where do you see the price of Tesla being at, or Tesla stock being at the end of the year and in 10 years?
Right. There's an old rule wise people on Wall Street pass on from generation to generation, which is if you put a number on a target or if you put a number on a prediction, don't put a date. If you put a date on a prediction, don't put a number. I am not going to predict where the Tesla stock price will be in a year or 10 years. I never, ever do that. And I think that the people who do it are guessing and misleading investors. The way I look at it is you look at the current valuation, you look at the current price, and you say, well, what has to happen for this to end up a reasonable investment? Now, for Tesla is a high-risk stock, and it now trades at 200 times forecast per share earnings for the next 12 months. In other words, the company is valued at 200 years worth of profits, if you like. The historic average on Wall Street is 16 years of profits. And for growth companies, sometimes 20, 25, 30, maybe even higher early on in their development. The last time I can recall something this silly was in the dot-com bubble, the famous one of 1999-2000, when I was early in my career as a financial journalist. And Cisco Systems was then one of the dominant growth stocks that everyone loved, all the money managers loved, and it went up to about 150 times forecast earnings, valued at 150 years profits. And obviously, it then collapsed along with the rest of the bubble. It proved a disastrous investment, and people afterwards were saying, what on earth were we thinking? When I look at the markets today, two things are telling me that we are not necessarily back in the 1999-2000 bubble, but we are in a similar scenario. These are real echoes of the dot-com bubble, and I'm not a perma-bear who was saying this 5 years ago or whatever. The first is Tesla and the second is Bitcoin. These are two parabolic price trajectories, things going through the roof. They look like a hockey stick, and they really make no sense. I did some calculations in an article I wrote for MarketWatch. I was taught this years and years and years ago by actually a money manager about essentially how do you back into a valuation. You take Tesla today. and you say, well, okay, what would happen if Tesla grows, if your Tesla stock goes up by 20% a year? I think people buying this stock at these prices are expecting very, very good returns because it's a high risk stock. You wouldn't buy it at these prices if you were expecting it, average market returns of 7% a year. So if it went up by 20% a year from here, in 10 years' time, it would be a $4 trillion market cap company. $4 trillion. To put that in context, the entire global car industry in 2019, before the pandemic, the entire global car industry made 85 billion in net income. So what we're betting is that in 10 years' time, Tesla is going to be worth more than 20 times the entire net income of the global car industry from 2019 figures. Now, you can play around with these numbers, but it gives you an idea of the order of magnitude, the kind of bet you're taking. You are essentially betting at now very, very, very short odds. It's a very unappealing bet. That doesn't mean it's going to go down this year or this month, whatever. And what usually happens in bubbles is that the biggest money is made right at the end, and the people who are short of the bubble, people who are betting against it, get hosed. And it's only when they get basically carried out of the market feet first that the bubble collapses. So I'm not saying Tesla's going to go down tomorrow or next week, whatever. I am saying I would not buy this stock at these prices. To quote a famous poker writer, Herbert Yardley, I wouldn't take this bet with counterfeit money. I would not bet on the stock at these prices. It makes no sense whatsoever. And if I wouldn't buy the stock at these prices, I would sell it if I owned it.
So if there is going to be a reckoning on the stock price, it's going to go down at some point. What do you think that the catalyst will be for that?
Well, this is a great topic of conversation. You've hit actually on one of the biggest sort of secret discussions on Wall Street. I talked to veteran money managers, people who've been around for decades, and people who often sidestepped or got out of the dot-com collapse and the 2008 collapse in time. And there is a lot of debate about whether there really is a specific catalyst. What actually causes the house of cards to topple over? And it's not entirely clear if there is a specific catalyst or if you can predict it in advance. It is easy. I remember in the dot-com bubble, the Clinton administration, I think it was the Federal Trade Commission, launched an investigation into Microsoft the week before the NASDAQ peak, essentially looking into antitrust issues. And that may have spooked investors in terms of worry about what government regulation might do to the industry, but that may have actually had nothing or very little to do with it after all. At some point, people become so extended, the sentiment becomes so bullish and so manic, and the valuations become so high that essentially everybody who wants to buy the stock or wants to buy into an investment is already into it. There's an old saying that I actually remember from 1999, which is that the bubble peaks when the last bear turns bullish. It's when the last skeptic gives up and says, you know what, I'm done. And actually, I do remember I worked at the time with a very, very distinguished financial journalist in Britain, one of my mentors. And I remember he had been a dot-com skeptic all the way along. And in the early week of March, he wrote an article of 2000. He wrote an article essentially saying fund managers couldn't afford to stay out of the dot-com mania because essentially the people who stayed out were getting fired. The prices were going up so rapidly that anyone who wasn't in it was getting hosed. And I just remember there were a number of old-time value investors who basically got fired from their funds in January, February, and March of 2000 and replaced by young people who immediately threw the funds into tech stocks. And that was sort of the last hurrah. So there is no perfect signal. There's no, this is going to be that. What I'm saying at this point, Tesla is already valued at more than most of the car companies you can name put together.
So who should we be paying attention to in the EV market, over or undervalued?
Well, I'll tell you this much, and let me answer that question in a very, what may seem evasive way, but it's not intending to be. the first rule of investing is to avoid losing money. The second lesson is to try and make money. So what I would say here is almost anything but Tesla. When you look at the rest of the car industry, whether it is Nissan or it's Ford or it's General Motors or it's Chrysler or whoever, Volkswagen, all these companies, you think you really are betting that these guys in total are going to have less of the car industry 10 or 20 years from now than Tesla will have on its own, that it's going to have essentially more than 50% of the global car industry? That doesn't make any sense whatsoever. And when you look at a lot of car companies other than Tesla, they are not desperately expensive. There is a very peculiar thing going on in the market right now, which is, again, very similar to 1999, 2000, which is that so-called value stocks, older school companies, companies that are not in the early trajectories of growth, are not that expensive. The bubble is almost entirely in the large growth companies like Tesla. So to be perfectly honest, if I were going to bet on the electric vehicle industry, I would probably at this stage be looking at buying a basket of older car companies. And I wouldn't buy one. I would look at a handful. You never know. You never know who's going to win. You know, Warren Buffett once said the only way to make money from the rise of the car industry was to get out of the buggy whip business, because you didn't know in 1900 which were going to end up as the successful car companies. And most of them, I mean, I think there were hundreds or even thousands maybe, went out of business. So you don't know who's going to win, but I bet you a broad basket of car companies will probably be better over 10 years or whatever than Tesla. I may be wrong, but I would be very smart. They are very cheap, and you're basically betting in this bubble. You're betting not only that Tesla will make great electric cars. You're saying BMW is never going to make a good electric car. GM is never going to make a good electric car. Toyota is never going to make a good electric car. Honda is never going to make a good electric car. Nissan, etc., etc. That is a very, very, very risky bet.
If you like the content, be sure to like, comment, and subscribe, and I'll see you again soon.